When you're trading options, Fidelity has just what you need with straightforward but powerful tools to help you select a strategy and execute your ideas. And they offer a wide range of information and insights to help simplify your trading experience. Have a question? Ask it live during their small classes and coaching sessions. Need information? Check out their educational videos, articles, and webinars. See why it's easy to trade options your way at Fidelity. Start now at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risks. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request. Although it feels like next Tuesday, it's only this Tuesday, Dan, this Tuesday being May 7th, 1 o'clock on the East Coast. Now, I'm back on the East Coast, as you may or may not be able to tell. G Swizz here. Dan Nathan back still in Beverly Hills or Hollywood Hills or, some
hills. I'm here in the hills. I'm back at Wheelhouse Guy, where we did our fine program yesterday. That was a whole heck of a lot of fun. And you did get on a red eye for the people. And you got back to New York. You're going to be on the set of CNBC's Fast Money. I'm still going to be at Milken. I'm going to be there this afternoon. We had a great day. We had a great day yesterday, didn't we?
We had a fascinating day. We met Mauricio Umansky. Apparently, he's the man out there. He's on this Beverly Hills
buying Beverly
Hills or something. I enjoyed that conversation. That'll drop at some point this week. And yeah, we were at the Milken conference. It was really a fascinating day. But I did get on a plane last night. And by the way, since it is Tuesday, the great Carter Worth waiting in the wings to join us. So it's a jam-packed session on this 7th of May. By the way, the Knicks emerged victorious in their second round game against the Pacers. Well done. And the Rangers play tonight. And Tim Seymour's birthday was yesterday. But I digress. Let's take a look at today's rundown, Dan, because why not? That's what we do. Chart check on the S&P 500. That's why we bring Carter in. Bullish trade on oil and Uber. That's going to be an interesting one. Tesla to retest its low. Let's take a look at that. And again, a little trade management with Pfizer, which actually sort of worked out. So there you go. Let's take a look at things, Dan. How are you out there on this? It's an early morning for you. It's sort of, 10 a.m.?
Yeah, it was a late night, early morning, but all good here. Big day, a lot going on in the markets too. It's interesting, this move in Disney guy. It's something, and you said it last night on CNBC's Fast Money. They said, they might have gotten that benefit of those cost cuts. Bob Iger put up a big show on that last earnings call, and this was right in front of that proxy fight that he was in with Nelson Peltz. We said it at the time when that stock had that huge gap. You know what I mean? Of course, they can pull levers. This is something that's obviously really important. We talk about this stuff all the time, especially when it comes to profitability and the like here. Cut costs, get margins up, tell a little bit of a different story. But man, you just draw that line right from those lows about a year ago, and you're up against a trend line there. Yeah. So that one is interesting to me. I said it earlier in the week on Fast Money. I thought that gap looked very vulnerable. Looked like just a bit of a something that was going to fill if that result and guidance wasn't up to snuff, guy.
Yeah, we discussed it on. Listen, early in the week in Fast Money was yesterday. It's only Tuesday, but I get it. I mean, I don't want to be a wise guy here, but with that said, we talked about, and I don't want to get too bogged down in Disney. We'll show Carter this chart, but we talked about the fact that they've gotten the benefit of their cost cuts and efficiencies and those things, and that manifested itself over the last couple of quarters in terms of the stock price. And I didn't think the market was going to give them a pass this time. And that proved to be correct. But we're a pretty interesting support level. I know Doug Cass has a note on, sort of dissecting the Disney stuff as well. So we'll see. Again, I don't know if it's overall importance to the broader market. I will tell you, probably somewhat on the back of that, Netflix has had this little stealth move to the upside. So that's pretty interesting, Dan. But although the S&P is up marginally today, I think 0.25%, there are sort of some things, again, under the surface that we're clearly taking a look at.
Well, yeah. I mean, actually, to be fair, we were talking about Disney last week, previewing it a little bit. And we were cautious there. A couple other names. Palantir is a name that you've talked about a little bit. And again, good quarter, bad guidance. Datadog, this is, a company that, was one of these ones that, for whatever reason, was deemed to be, part of this kind of enterprise software thing that we saw in 2021, into 2022. Yeah, it can't get out of its own way. And there's a bunch of names in the security space too, Guy, that I know they're trying to tell a little bit of a generative AI story and how it works into their products and services and the like, but it's just not working this year on a whole host of names. So I think that's just really important to keep an eye on. But again, we spent some time yesterday on Market Call. The S&P, what do you say within a whisper of those
50
previous
day.
all-time
Yeah.
highs
Yep.
here? And I guess the question I have is, as we get to the end of this S&P 500 earnings cycle, and we know that in a few weeks we're going to have Nvidia, and that's the only thing we're going to focus on. It feels like for the next couple of weeks on the earnings front here, but it just feels like what is the thing that propels the S&P to a new high, Guy? Is it that rates just continue to go lower? We continue to have soft data, which can't be great for the economy, right? And I don't know if that's good for S&P 500, but if rates go lower, the S&P goes higher. Is it that simple? If the dollar goes lower, if crude goes lower, or yields, you know what I mean? Like, I don't know. And I don't know what the thing is that propels it higher right here.
I don't think it's that simple either. But what we've learned is, in the absence of bad news, markets tend to sort of levitate for whatever reason. And I think to a certain extent, you're probably seeing it here. But we also listen. I thought this happened last week, but we were clearly in a very short-term oversold condition, which I thought got worked off last week. Obviously, that's not the case. But we can talk about it all we want. The real important person to bring in is Carter Worth. So we might as well do it now, because he's brought forth some charts that might illustrate things a lot better than we can do by ourselves, Dan Nathan.
No doubt.
Carter.
That's a big lift. I don't have any.
Very many can do it. You're the vastly of Alexia.
Point is, look, we're all in the dark in many ways, and then you use the tools you have, and hopefully you get a small flashlight to put a little clarity in an otherwise the very gray, murky, and treacherous world of risk assets. But anyway, let's look at some charts of the S&P and just see what we can see. So here is a chart that effectively picks up the bear market of 2022. We dropped 27% of that low. That was the spike in interest rates above 5% or close to it. And then we've rallied mightily and handsomely, of course, over the past year and a half. But let's put some lines in, and we can flash these if we want. But the point is, we have a very distinct set of parallel lines. So the market quite clearly is ascended within this channel for the better part of 18, 20 months, and then moved out through the top of it, getting fairly extreme, from which we've had this recent sell-off, from which we've had this recent ricochet. So now the question is from here. And it really is, there's two distinct camps. That the sell-off, despite this ricochet, is not at an end. That's the camp I'm in. And those that have said it's done. We're all done with it. Earnings are out of the way. Fed is out of the way. And so now it can just rally, because there's always new money being put into the market, monthly contributions to IRAs and 401ks, and people are always long and strong in America, and 99% of all assets are long, which is true. Short interest at any given time is about 2% of all stocks. So why fight the facts? Anyway, my hunch is, again, that this steep, uncorrected, and now somewhat corrected 6-month advance from the October low to the February, March high, 28% in the S&P, that the dip isn't quite enough. And it would be, maybe, as the British expression goes, too clever by half just to get out of this and go on and make new highs.
I've heard that expression. And, I look at this channel, again, it's been in place for a while. We sort of violated for a period of time to the upside, broke back down through it. It's interesting that breakdown, I think, quite frankly, I think bulls would have been a lot happier if we probably traded down to that middle point and bounced, because that would be suggestive of exhaustion to the downside. But the fact that we didn't, I think, leaves both camps sort of scratching their heads. So to your point, here we are right back up against what should be resistance, and we'll see how it sort of plays itself out. As in these up channels, with each passing day, the support levels get higher and higher by whatever, a magnitude of a couple points here or there. So that's what we're dealing with, Carter. And I'm sort of with you. Dan sort of alluded to it earlier. But I guess in the absence of bad news, as I mentioned, markets tend to levitate. It's just a really question of how long can that last.
Yeah, Guy, it was interesting. We were kind of trying to come up with some ideas, what would be things that would like kind of signal the all clear for equity investors, right? To take the S&P through those prior highs and then just kind of break them out into quarter end, that sort of thing. One of them would have been a ceasefire, a meaningful ceasefire, between Israel and Gaza, right? So you would see some inflationary pressures come down. There's a lot of companies that we've seen, multinationals here in the US, who've kind of signaled some of these geopolitical reasons why, their sales maybe have started to decel a little bit here, but that doesn't seem to be on the table. So again, all eyes are going to be focused on Nvidia in a few weeks. And Goldman had a note out this morning, talking about a beat in this quarter, and that's something that we've been highlighting, the fact that consensus is already calling for 80% plus earnings and sales growth this year. Well, the stock's up well over 80%. So unless you continue to get bigger beats than the street expects and investors expect, that's going to be something that I don't think will be supportive of the stock here. But then also on Squawk and Friends this morning, Stan Druckenmiller, kind of a legendary investor, said that he sold his stock. That company gained $1 trillion in market cap in a very short period of time, sold it in March. And it was interesting that the stock was down off of that over what Goldman had to say about the future. And I think that's the sort of battle that plays out this summer. And it's probably not too different than the battle that we saw play out from that July period last year into the fall, because again, as Carter just said, in the absence of this or that or whatever, there is going to be no resolution on yields unless we get some data that is so stark, either that inflation reaccelerates and then your main man Kashkari, like he wins out and he says, well, they're going to have to remain vigilant on higher for longer, that sort of thing, or the data is just weak enough that is leaning the Fed, right, to cut. So that's the debate. And we're going to have these pockets where single stock names in earnings like Nvidia are going to take over the narrative, but who knows if they're going to be the big driver. Guy, does that make some sense to you?
It makes perfect sense to me. I mean, I do think there's an importance to Nvidia. Listen, I'll go back again. Although that March 8th date, that Friday, that high is still in place. Now, the bounce from the low 700s recently to where we are now is clearly interesting, but that formation, that engulfing pattern has not been violated. So we'll see how it plays out. But to your point, there's clearly a tug of war going on when you hear, obviously, Goldman Sachs on the one end of the spectrum and Stan Druckenmiller on the other. But I think in terms of the dollar and rates, I mean, it goes to oil. And Carter brought some TI and USO charts along as well. So let's go through those, Carter.
Sure. So here's a one-year chart of oil, right? You've got a high of 95, you got a low of 65. And after any sort of 6, 5, 7 month move, a mature intermediate advance in one direction, the extrapolators come in. So up in August, September, when we were 95, 110, 110. Of course, what happens? It goes the exact up, drops. Down in December, it's at 68, recession. There'll be 12 cuts. Rallies to 88 just from 3 weeks ago, and oh my God, we're going to 100 again. Listen, I think you try to take counter trend moves and take advantage. Is this a counter trend move? That's my hunch. Call it 9, 10, 12%, doesn't matter what you call it. Look where we're down to. Next chart, we've come down to a trend line. And so I think you can show how precise it is. It's to the penny. Next chart, you'll see. And my hunch is you play for a bounce here. And so does it have to bounce? Of course not. Is it a thesis? It is. It's a counter trend move. It's down to the penny. You play it. And the beauty of a trade, right, of course, is you just like an options trade or any other thing, or you're playing for an earnings event or a FDA approval. When news or some other data point comes out to either invalidate your thesis, your fundamental thesis, or in the case of technicals, it starts to break the damn line, then get out.
Right. Before we get to USO, I'll sort of opine quickly, Dan. I'm obviously in accord. I did not think you'd see this dramatic a move to the downside, so I want to be crystal clear about that. With that said, I think this uptrend that's been in place since December has not been violated yet. And I understand to a certain extent, only in retrospect, this move lower. Obviously, the GDP didn't help. I think some of the news we're hearing out of China sort of, their gas demand is down on the back of electric and hybrid vehicles. That doesn't help. And you throw on top of this, probably again, just general slowing economic data, and the fact that to a certain extent, to your point, geopolitical risk is sort of get pushed to the back burner. So it all makes sense. with that said, I don't think a lot of these things have really gone away. So I think this is sort of, Dan, in my opinion, this is just temporary. And I'm with Carter on this one. I think this is a level where if you're pushing through the short side, I think you're pushing against something that's just not there.
Yeah, no, again, and let's look at the USO, the US oil fund that tracks the price of oil here. And I think this is a good one, Carter. In your charts, they look different time frames than what we were looking at the WTI, but they kind of inform the strikes that I'm going to use for this options trade. If you could kind of walk us through those.
Yeah, so it's the same sell-off, right? Obviously, it's same sell-off in USO from the peak that we saw in oil. But the hope here was to, again, show how precise certain levels are. Those two tops are within about 6 cents. Is that because of GDP, because Venezuela, because of the Strategic Petroleum Reserve, or it's nothing to do with any of that. Here we go, a perfect double top. Let's put the next set of lines in. A drawdown, call it 10, call it 12. Let's put the next set of lines in. A lot of symmetry here. Let's put the next set of lines in. So we're just going to trade the chart. If you get to a former high, you start to struggle, you bet maybe it'll break down, call it a double top. You reverse like this. So does this have to work? No, but levels matter. There are rules of symmetry that are very important and historic. And to my eye, after a 10, 12% sell-off to a trend line, which we saw in WTI itself, you play for bounce.
Yeah, no doubt. And again, I think we're talking the same language here a little bit, defining your risk, because if there was some sort of headlines, whatever, you just listed a whole bunch of them that sometimes affect sentiment towards these sorts of risk assets. We have no idea what's going to come, which is one of the reasons why at this technical level, it caught my eye. I like the fundamental kind of framework that Guy is thinking about. So I want to define my risk. I want to look out to June expiration. So today when the USO was trading about 75.23, I could look at a June call spread. Let's look at the 76.83 call spread. It cost me about $2 buying one of the June 76 calls at about $2.50, selling one of the 83 calls in June at about 50 cents. So again, that $2 in premium that I am spending is my max risk. I have a break even up at $78. I have gains up to $5 between 78 and 83 with a max gain above 83. I have losses of up to $2 between 78 and 76 with a max loss on June expiration of $2. I like the risk reward of this trade. I'm risking a little more than 2.5% of the ETF price. I have a break even up about 3.5% with a max potential gain of $5 or about 6.5% if the ETF is up 10%. That kind of lines up with Carter's view of playing for that counter trend. And I'll just mention this, we talk about this all the time. You spend $2 on a call spread like this. I'm risking 2 to make 5. It's not ideally like the kind of relationship between what we like to spend and what we like the max potential to gain. But like in all long premium directional trades, I'm going to basically put a mental stop in. If the ETF goes sideways or down, and let's say that call spread is only worth $1, so I'm down $1, I'm going to look to cut that trade. Okay. And one last point, I just want to pull up this chart. This is implied volatility, the price of options in the USO. And if you look at the one that's blue, and you look at the one that's white, the blue one is implied vol, 30 days at the money. That's basically saying what the price of USO options are. The white line is realized volatility. Okay. So it's below that. And if you look at that, that's very near that double bottom low. So the spread between, let's say, the implied volatility, the price of options, and the realized is not that great here. So it's basically saying to me, I like the risk reward of this, despite it's not a quarter of the width of the spread that I'm doing. But if I get a double on this thing, I'll look to take profits and let it ride a little bit. But again, I'm going to let the technicals kind of also inform me too. If I get a 10% move, I'm going to be out of this thing.
And let's take a quick look at our chart in USO, because we threw a moving average in, we threw a bit of an uptrend line. So you could see, it all sort of makes sense. I'm not suggesting our lines are better than Carter's, but you can see where the 200-day moving average comes in, where it's theoretically the support in this uptrend since December comes in. So, to my eye, it makes a little bit of sense. Carter, real quick, opine here before we move on.
Sure, it's the same setup. It's not quite as maybe we can toggle here. Look at the WTI chart, and we can pull that up with the arrows to make a point. And then look, this is meant to be close, this instrument USO to WTI, but the concept is the same, right? So those are precise lines, and it's not that those lines. Now let's go back to USO. Were drawn wrong. It's just that it didn't lend itself to having precise lines. The USO doesn't happen to have very precise intermediate lows, hence the green line, clipping the other thing, not really touching. It's not about the drawing, about the person who did that work. It's that this chart doesn't lend itself, but it's not about that. Sometimes the lines don't have to be precise. It's about the concept. Is this a sell-off? Yes. Has it happened over 4, 5, 6 weeks? Yes. Did it start at a former high, a double top? Yes. And is it sort of down to a level where, hey, we could play for rebound? Final answer, yes.
Trading options might be new for you, or maybe you've been doing it for a while. Either way, Fidelity is your go-to source for clear and relevant information about trading options. For example, ask Fidelity professionals questions during their live small classes and coaching sessions, and learn more with educational videos, articles, and webinars. Plus, with Fidelity's straightforward tools and technology, you'll find it easier than ever to trade options your way. See what's waiting for you at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request.
All right, guy, that was a mouthful. All right, let's hit Tesla here really quickly. So again, at the Milken conference, really interesting. This is really about fund managers and fund allocators. They're not here to get like ideas in the markets and the like. They're here to meet up and they're looking for money. Okay, it's that simple, right? And the allocators are looking to, provide that capital to what they deem to be great investments. I do think it's interesting, guy. It was a late ad. I think it was just about a week ago that Elon Musk signed up to be like a keynote. This is not one of those sorts of conferences. We also talked about on Fast Money that I guess with the Berkshire event going on, we know that Berkshire Hathaway is a huge investor in BYD. That's the Chinese EV maker who's been eating, Tesla's lunch in China. You saw the news today. They're sending back one of their senior execs. This is Tesla to China. He's a Chinese national who was brought over here to manage the U.S. business as a lot of executives over the last couple of years. They're sending him back to China. I guess his nickname is the fireman. They're trying to put out a little bit of a fire there. And, there's some April data about Chinese deliveries. They're not going well. We know there's a huge market for them. So the Tesla story continues to get worse. The NTSB, which regulates full self-driving and the auto industry in general, is put out, a lot of requests for data about their full self-driving. So Musk was over there a couple of weeks ago. He comes out with some BS announcement about full self-driving. The stock had a huge rally post-earnings and on that. Carter's going to look at the charts for us. I just wanted to pull up one chart over the last year. Guy, you and I have been talking about this, and maybe you can speak to this a little bit. Over the last year, when the company, prior to this last report, had reported earnings and given guidance, the stock gapped down on 4 occasions, down about 10%. Now, once it bottomed out after that, it had these huge rallies, okay? And you can see them there. But what happened this time is that the delivery number was so bad, guy, for Q1 that the stock gapped down 10% after the delivery number in Q1 was listed or posted in early April. And then you get to the earnings report, and after such a tremendous decline over such a short period of time, stock bounced. Then you had the China announcement, FSD. There's no real announcement there. I think this sets up as a good entry, defined risk on the short side, guy. Thoughts here on what I just laid out about the price action in around earnings?
So you're right about the price action. You've identified that a number of times. It's correct. The times when fundamentals seemingly do matter or have been times where the stock has had moves to the downside. With that said, and again, I have no feelings whatsoever about Elon Musk, but what I will say is, and I would say this about anybody, when you have a CEO of a company publicly basically asking for an investor, not least of which Warren Buffett, to take a stake in his or her company. I mean, that reeks of desperation. I mean, he could have said something like, clearly Warren Buffett and his team at Berkshire Hathaway are aware of who we are at Tesla. I hope he sees the same value that we do and millions of other shareholders do. That's it. I mean, but, I didn't write his little speech there. But then when you see these different trips, that also sort of, again, to me, reeks of desperation, and maybe justifiably so. We have pointed this out a number of times, Dan, since, the last 3.5, 4 years. I mean, this stock has vastly underperformed the broader market, and every rally of the magnitude that we've seen, like we're seeing now, has been sold. So I'm sort of with you on that.
Yeah, Carter, you have a slightly different view on the chart, and this is a chart that we've been updating for months and months and months, because this pennant formation triangle, whatever you want to call it, has been making itself over the last 3 years, which
Sure.
Guy talked about. The last time, that all-time high in late 2021 was $400. What did we get as low as 150 just a few weeks ago? So talk to us about what you're seeing. And I think I have a trade that is, it kind of lines up. It's not like the most pound the table definitive bearish trade, but it's a way to use options and leg into a bearish trade.
Right. So, I mean, look, if one has to have a final conclusion, look, I think that ultimately it's $100 stock. The people talking about 50 and 20 and out of business, and no, it's all just, okay, that is not a reality. But 100 is a reality. The problem with 100, and this is, I don't have any trades on this. In fact, we currently have a strangle on, right, which it's going to fire perfectly right inside the thing next Friday, is that's a longer term view, 100. We can put the lines in. It's the same lines we've all looked at together. Those are very precise. And I think we're just going to vacillate here inside this. But when you get a very powerful bounce, as was the case, up 40-something%, with gaps, news related or not, whether it's real news, there might be some deal in China, it doesn't matter. That kind of money moving into a stock is not that quickly reversed. So just because there is a gap, it doesn't mean it's immediately in play as a prospective fill. When you get a move like this off of a level like that, you don't unwind it very quickly. You can unwind it over time. But again, a lot of capital was pushed into the stock, and that capital doesn't reverse itself all that quickly. So in principle here, for me, this is bet against volatility because it's been very volatile.
Yeah.
And
Yeah,
now,
well, listen, and I see all that. I want to really lean into the fundamentals here, because I think after a 40% rally after that news, and we said it at the time, we didn't think it was a good press into the earnings announcement. But what I've heard fundamentally since then, and to Guy's point about that kind of pick me, tweet that he had to Warren Buffett on Sunday about buying the stock, listen, I think that rally is enough. I think it was a lot of shorts covering. I think they probably felt it was bad enough in the meantime, but there is going to be a play back towards 100 at some point. And I'll just mention this: if you don't think it could, break 100, you continue to have, Guy, the sort of losses they had from a cash flow perspective, in that last quarter. If the fundamentals continue to get worse, right? And, this could spiral out of control. So to me, I feel like this thing is probably, you want to set up for early July, the first week when they're going to announce, Q2 orders. So when I think about this, I just don't want to buy outright premium puts, put spreads and the like. Carter's talking about selling volatility. I want to do that in a way. I want to use a put calendar. So I want to buy a longer dated July put, and I want to finance it by selling a shorter dated May put. That's next week. That would be a put calendar. So here's the example of the trade. When the stock was trading about 180 today, I want to look at the May-July 170 put calendar, selling one of the May 170 puts at about $1.75 and buying one of the July 170 puts at about $9.50. That cost you about $7.75. That is your max risk. Because just think about this. You're buying the long dated put. You're selling a short dated one. Okay. The worst case scenario is you lose that 775 on a percentage basis. That's not so bad. But if I get to next Friday, May 17th, expiration on Friday, and the stock is above 170, that short May put that I sold expires worthless. And then that July put that I bought for $9.50 only cost me $7.75. And if the stock is lower, that's going to increase in price because there's not going to be that much decay on that July. And then I can look to do another put calendar, or I could sell a lower strike put and take in some more premium and create a vertical put spread. So that's how I'm thinking about Tesla. I agree. Let me just tell you, pull Carter's chart back up there. You look at that downtrend, Guy, and you see if this thing had any legs, it easily could go back to 220, 225 or something like that. That's why I don't short a stock like this. I look to use options. I look to define my risk, and I look to be creative and create structures that might make a lot of sense of legging into a position.
And it gives you, it gives you some time without question. Number one, gives you flexibility, and you have a bearish thesis, which if it plays out will allow you to do other things as well. So I totally get it. Let's take a look at quickly the earnings calendar this week. Obviously, here we are Tuesday. And the one that sticks out to us, and we're going to talk about quickly, is Uber. Obviously, we're through Tyson, we're through Disney. Lyft, I guess, is sort of interesting. We mentioned some of these software names that haven't traded particularly well, but let's take a look at Uber, Dan, because I do believe you also have some ideas for a trade here.
Yeah, so Lyft is going to be today after the close. We had DoorDash last week. We know that basically Lyft is, just North America rideshare. We know that DoorDash is North America food delivery. We know that Uber has both of those things. They also have international businesses. This is a company that has been inflecting on a GAAP basis. They are starting to earn a lot of money, and they're growing GAAP earnings at 50% or more. Is trading about 50 some times. Their sales growth is in the mid-teens. So that's something, that you want to keep an eye on, because that is not hyper sales growth. But if their margins can improve and get back to pre-COVID levels, which was north of 50%, they're low 40% or so, you're going to see profitability go up. So this is not a stock that I'd say that looks expensive right now, but couldn't get cheaper, couldn't grow into that valuation guy. It had that big quarter. It made a new all-time high 3 months ago at about $82 or so. But since then, it was really kind of consolidating, and then it broke down. It's massively underperformed the NASDAQ over, let's call it, the last couple months or so. Carter, I think you probably tell me it's a pair of twos. It's in no man's land. You saw that 82 resistance. You see that 60, and then see that rising moving average up there at about the similar sort of level. It doesn't speak to putting on a directional trade right now. But I'll say this: if you're long the stock and you think that some of the other names in the space may cause it, the sentiment to get worse for these kind of, gig economy stocks, whatever you want to call them, and let's say you don't see accelerating revenue growth here and the margins are flat to worse, the stock's going lower. Like, that's just my 2 cents here. So if you're long and you say, all right, I'm more worried about extreme downside than I am extreme upside into the print, you could consider a collar. And I want to use this trade structure as something that you can use, for any sort of security, you know what I mean, where you're long it and you want to participate to the upside, but you're willing to sell an out of the money call at a price where you could get called away on that stock. So you're basically putting a limit sell order on your long position. So you got to be comfortable with that. Okay. But you want to use that proceeds of that call sale to buy a downside put. And this one sets up kind of interesting, because oftentimes you will see, some skew in the puts versus the calls. In this case, I can sell a $9, if I'm looking to June expiration, a $9 out of the money call for basically a similar price for a $7 or $6 out of the money put. I'm going to do that every day when I have the opportunity to do that. So this is what the collar looks like today when Uber was trading at about 71 versus 100 shares long. I want to buy the June 80.65 collar, paying about 20 cents for that. I have gains in the stock up to $80. That's where I get called away on June expiration. If the stock is below that, you can cover it. That's one of those things where at some point, if that call that you sold for about $1.70 is worth like 25 cents, you may kind of take that in or so. And then you're buying one of the June 65 puts for $1.90. So you have basically losses down to $65. You're protected below that. You have gains up to 80 between now and June expiration. I just like the setup in a name like this that I think has the potential to be controversial. Thoughts, Guy, on how I'm thinking about an Uber into the print?
Taking advantage of the skew. If you long the stock, this makes sense without question. And, you highlighted it. $9 of, listen, you can do the math, but it's $71. You're selling an $80 call, which is obviously $9 out of the money for $1.70. And you're able to basically do the same thing. I mean, you're able to offset the cost of the put with the sell of the call, and that's only to the downside $6. So listen, I think it makes sense. You said you do it every single day. I think that's right. And again, this is a trade you put on if you're long the underlying stock, Dan.
Yeah. Carter, thoughts on like that was a quick chart. I know it's not the work that
no,
you do.
all right. So we have a report on April 30th, playing for a bounce. I'm on the long side of this one, but I think colors are always prudent.
All right. We got you there.
Listen, go ahead. I mean, Carter's got to jump. So W, we're going to let you go real quick. And we obviously always appreciate your, you're just joining us and bringing forth
all good. Yep.
Your knowledge. You remain the man. Real quick before 5,000, Dan, the Pfizer trade that we put on, I think it was last week. I mean, that's sort of, we were taking a shot in terms of the levels we had a whole conversation. You can go back and listen to some of the things that we said and came to fruition. So let's do a little bit of a trade update here.
Yeah, so Carter, this is one guy where if you just, mentally you can draw that downtrend, and it's been pretty extreme, right? And we were kind of highlighting the fact that the stock had kind of gotten back to those couple levels where it had good bounces, and we weren't playing for a massive bounce. We were looking to kind of define our risk at a couple percent of the stock price, playing into the print. We thought that maybe, as a term that Carter likes to use, so bad it's good. So, we were buying the 26 call, paying about 50 cents for that. So a break even at 26.50, and you just do the math. It's trading like stock right now. You're going to take the profit in this thing. You're going to make $1.70. That's 3 times your money when you're risking 2% of the stock price. I just kind of like the risk reward of trading, earnings events like this, trying to be a bit contrarian, and that made some sense in this instance. But again, this was going to be a binary trade, because if the stock had gapped down lower, guy, after the results, that 50 cents would have been worth about 2 cents.
Right.
You know what I mean? Very quickly. So this one worked out. We don't love to just kind of throw lotto tickets out all over the place in this sort of thing. It's a name that you knew fundamentally, you thought that's probably a good spot to take a shot into the print.
Yeah, I mean, there was clearly an aspect of taking a shot, but we also had a pretty defined risk, and we looked at levels that sort of made sense. The push to the downside was probably excessive. Pfizer has not figured out their problems at all, but this is a classic relief rally on the back of what's been a pretty significant downtrend. So, that one worked out. And again, if you put on that trade, it's incumbent upon you now to do something, either take the entire thing away. I mean, what the routine is: take the entire thing off, take half it off, whatever it is, but you got to move your feet.
Yeah, no, I think you take the profit. All right, we covered a lot of ground here, a lot of single names, a lot of some ETFs here. That was a lot of fun. Before we get out of here, Guy, I did not know that you're doing male modeling here, because this is a good tie-in if you think about it. So our fine partners over there at the CME, they have this commodities trading challenge. You and I have participated in a few of these. This has been a lot of fun, and just to get some of our users, our viewers, our listeners to get all geeked up about joining this, we're gonna throw in a little market call t-shirt there. And again, I don't know why they cut your head off on this, but your pipes look great, the shirt looks good on you. So if you want a shirt that Guy Adami has been modeling, you know what to do. You go to the website, you sign up for this trading challenge, you take a screenshot, you send it to Amanda at contact@riskreversal.com, and you're getting a market call shirt. How cool is that, Guy?
That is,
that's pretty good.
And by the way, if you like these I didn't know I was a model either. If you like these trade ideas, if you got an inbox, why not get them in your inbox? Makes perfect sense to me. So throw that slide up, because that's what we're doing here.
Yeah, sign up. And all of our charts, all of our show notes, more detail about the trade ideas, the way we kind of write them up. And I don't know, we're probably a lot like you guys. We're not just kind of willy-nilly coming up with something and hitting the buttons on our trading machines. We like to think them out. And we also, not only if it's a bullish trade, we like to think about how it might go wrong. If it's a bearish trade, the same thing. So again, it's really important to know the other side of things. So we put some more detail in the show notes. Go to riskreversal.com, sign up for the newsletter. It comes out every day, and on days we do trade ideas, there's just more detail there. So we appreciate it. And Guy, you're also on the Insta. You're guy.adami.
Sure.
And we have @riskreversal media. I'm Dan S. Nathan. We're putting some updates on there too, so check that out.
I think you put up a video of me crushing Galaga at Wheelhouse yesterday. The first time I had played the game, probably since, I don't know, the 1990s or so, but it's like muscle memory. It just sort of comes back to you, like many things in life.
Yeah, well, that's on the gram, as you like to call it. So check that out. I got to thank our friends here at Wheelhouse, my good friend Brent Montgomery. We had a great couple of days here in their studios. They're very fine on the Sunset Strip. Great team out here. So I thank those guys and gals. It's been fantastic. And again, check us out on CNBC's Fast Money. We'll be on there today at 5 p.m. Guy.
Tell the cats at Wheelhouse that I miss them. I enjoyed their company and their stewardship and their professionalism in the face of my lack of professionalism.
All
but
right,
that's
they're all nodding for you, buddy.
Of course they are. So listen, I think it's me and EY from SoFi tomorrow, I believe.
Yeah.
And then maybe me and Carter on. It doesn't matter. But Dan is out there. So say goodbye to Dan, folks. We will see him soon. Thanks for joining us, everybody. See you later.
See you later. Thanks.
Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risks. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request. Fidelity Investments and Risk Reversal are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.